Hi, everybody. Good. So welcome to the session. And first of all, thank you to Digital Fifth for doing this summit, for inviting us, for giving us some time. And I myself very excited to learn a lot of things and to see what's happening in the investment industry and the trends. So I would love to start with both the speakers and panelists just to share a little bit about them, their background, what they're doing, and then we will discuss certain things, yeah? So, Anuradha, please.
Hi, everybody. First session after lunch. I hope there's a lot of energy left in the room. I'm Anuradha Ramachandran. I recently joined as managing partner in TVS Capital. TVS is a mid-market PE firm which invests in companies which are at the growth stage and right through to IPO stage as such. We are, unlike what most people think, we are not a family office, but I guess we are a proper fund, but it is a completely rupee-denominated fund as such. So domestic capital is what we kind of deploy. And most of our investments, about 80% of my current portfolio is in financial services. And we have, supply chain, logistics, tech and B2B as other areas that we've kind of invested in, both in the current fund and in the previous funds as such. Before this, I was with Flourish Ventures, which was a pure play fintech investor, a part of the Omidyar group. And, I continued from my tenure at Omidyar Network India, where I used to lead the financial, fintech practice as such, and built it out in India as such. That's a quick, I've been in the VCP, area for about almost 15 years now, and it's been an exciting journey. Thank you.
Hi everyone, Vikram Gupta. I founded IvyCap in 2011. What we do at IvyCap, we manage about 4,500 crores, all domestic capital. We do seed to Series B investments across sectors. We do have a portfolio in fintech as well. We have a total portfolio of about 40 companies as of now. What we have different is our anchor sponsor investor is the IIT Alumni Trust. We have a collective pool of large alumni of IITs who invest through the alumni trust into our funds. And the rest of the capital comes from the domestic institutional investors and a few families as well. Our ticket size is anywhere between 1 crore going up to 50, 60 crores in the first check itself. And then we do the follow-on as companies scale up. We go up to 100 crores in the follow-on rounds as well. The reason we are able to engage the alumni in a very passionate manner is a substantial part of the profits that we make as fund managers goes back as endowment to the IITs. And we were instrumental in setting up India's first endowment fund at IIT Delhi. And we would like to continue passionately building the endowment ecosystem in the country. So that's what we do at the core of IvyCap Ventures. So that's who we are.
By the way, in between the session, I will ask everybody once in a while if you have any questions, so please be ready. Why don't we start with some of the investments in fintech area both of you have made, your firms have made in the past. And around that time, if you can go through what kind of thesis you had, what was evolving, and it will be great to start there and then we'll pick up from there, yeah? Yeah.
I can go first. The three main investments in fintech that I would like to mention. One is a company called FT Cash, which is actually an SME lending platform with an average ticket of about 5 lakh unsecured lending. The founder is walking here right in the middle of the aisle. So that's one of the companies that we started very early with a 6 crore check, and then over time we've invested substantial capital. The second one is a company called Lendbox, which started as a P2P lending platform. And over time, it is actually transitioning into a wealth management platform. Um, they do almost about 150 crores of monthly lending through the platform. And then the third one is a company called FinPay, which is a rural banking platform, now leading to a neo-banking platform. It's a B2B model rather than a B2C model. So they work with a lot of merchants across rural India to provide the payments or rather the cash disbursement solutions through the platform and providing other ancillary services as well. So these are three main companies. Usually we like to take substantial stakes in our companies, between 25 to 30% in each of the companies that we were invested in. So we play very active roles in these companies, on the boards of these companies. And each of these companies have a very unique model that they are working on with a unique set of markets that they're addressing. FT Cash, of course, has really created its unique positioning with respect to the SMEs, specifically merchants and small kind of these small enterprises who are actually looking for mostly working capital loans. The average ticket of 5 lakh. It's a very unique model because the idea is to really do a daily collection model, which actually works very well. So therefore, the NPAs are very low in this model. Lendbox, on the other hand, has actually become a very interesting model. Of course, when P2P lending started in India, we had seen a few players come up with a very specific license that was given through RBI, which was NBFC P2P license. But then there were, some question marks in terms of will this model scale? Is it going to be profitable? Are there going to be challenges with respect to regulations and other things? Of course, with the limits on how much you can lend per person and how much you can invest on the platform. But I think while this model itself, is going through a very interesting transition, I think the opportunity lies in actually understanding the consumer behavior in terms of why they're borrowing and where they're using that capital, and therefore using that data to actually help build other sides of the businesses, including the wealth management for the masses kind of a model. So these are some of the models that we are working on. So happy to talk more in detail if want to discuss.
Anuradha?
Sure. My initial introduction to financial services and fintech investing was at Omidyar Network. And frankly speaking, when I was handed the portfolio, I was really clueless, right? Sure, I knew banks, I knew insurance companies, but that was the extent of it as a user, right? But that was the extent of my knowledge. I came from a tech investing background, so it was a bit new in that kind of a sense to me. And then one of the key things that I noticed was there was a lot of jargon floating around. And it took me quite a bit of time to just figure the lexicon in investing in the first place. Interestingly enough, coming from the background of the company that acquired PayPal, obviously our first stop in investing was around the space. At that point in time, there were two things that actually, while we look at most of the players, this was pre-UPI days, most of it was wallet-based, if you will, prepaid instruments. We looked at all the players, and for us, there was a lot of uncertainty on two counts, right? Consumer adoption in usage, the friction in usage, more specifically, and then there was the regulatory overhang, which was not very clear. So on a contrarian way, we started actually investing in pure MSME lenders, pure play NBFCs, which were technology enabled, not necessarily technology first. So in that context, we actually invested in about 4 lenders. Neo Growth was our first investment, Intelligro, which is now called Ashwa Finance. Then we invested in Vartana, which is a school lender. Sorry, our first investment was in the company called Vistar, which was just a rural, like lender directly, but just above the microfinance ticket size as such to individual entrepreneurs. So that's the first portfolio of companies that we kind of like built out. And using that experience, we were of lending purely, and the way that actually like banks played in the ecosystem or NBFCs played in the ecosystem, we went on to define our next thesis as actually, creating financial prosperity, right? Like in financial management for individuals, individual consumers, as well as for small businesses as such. Globally, the portfolio had already had invested in many of the pure play underwriting models, like using alternate signals for underwriting loans. But in India, we felt that actually the play could not be purely one piece of the whole cycle. So we invested in Zest Money. We were the first investors in the company, for example. And we invested in IndieFee, Zest on the consumer side and IndieFee on the small businesses side as such. We also invested in Scriptbox, which is a wealth manager, based on again, the same thesis that, as I said, if I had found financial lexicon difficult, being in the financial services industry, it is very difficult for normal people to function, right? So our thesis in investing out there is simplifying investing. So what Scriptbox used to do is to give you a set of curated 4 funds in equity, 4 funds in debt, and 2 funds in emergency, and say that think about this, like the way that you would think about fixed deposits, right? Like 18 months to 24 months, put that in debt funds. If you think about what you need in your savings account, put that in liquid or emergency funds, and then whatever is for long term, put it in the equity funds and go to sleep, right? We'll manage your money for you. That was an interesting way for evolution. So that, and we thought that would actually spur quite a bit of adoption as such. Similarly, we'd invested in companies which were looking at different segments. So for example, our Ford Plan did this for healthcare spending. There's this company called Kaleidofin, which actually does this for microfinance borrowers. They would create their bank account and help them actually manage their wealth. And then there were companies like Bond, which was about liquidity creation for cab drivers. They were companies which were where they had looked at much of this was around the thesis around digital investments as such. The next wave that we saw was around 2 counts. One is around where we saw our portfolio actually coming in through what is known as embedded finance, where finance is a part of the overall transactions, but is not at the forefront. It is a definite oil, but not necessarily the machine. And the second set was in payments infrastructure. By this time, we'd already evolved into Flourish, which was a VC firm separate from Omidyar Network as such. On the digital infrastructure side, we invested in M2P and YAP, alongside Hero, if you will. And then we actually had other investments in the embedded finance side. We did one which was Kirana Tech, one which was actually, one which was Aqua Connect, which was in in aquaculture. And the third, which was actually for small businesses again, which was an accounting, which sat on top of an accounting software. It's a company called Credflow. All these with the intent, finally, that we would actually get into alternate signaling and then build out a lending business. One thing we were fairly clear, through these investment cycles, one thing was actually fairly clear. Monetization-wise, lending remained the largest monetizer in the financial services segment. Payments, if you can build a company with a pretty tight layer of people, right? Where your costs are fairly tight, keep that very simple and use that as a gatekeeping mechanism. Payments can make money, but customer acquisition was very, very expensive, right? So you had to find a way of acquiring customers without spending money and then run a very thin layer of a company. So that was the second thesis that we kind of came up with. The third one was it is important for people to both manage money, nobody thought, and then build prosperity. Building prosperity, decisioning was still a big problem. And it was also, you need to build trust. So to build great institutions will take a lot of time. That's one of the key learnings that we had. So therefore, was that a VC investable model? Or was it much more actually like something where permanent capital will take, like its role? Is the question that we still have as such on the wealth management side. So that's a quick introduction of like, in TVS Capital, on the other hand, again, on the digital, most of the investments are around the small businesses, five-star business, which just went public. UB, which earlier used to be called Cred Avenue, which is digital lending infrastructure for MSMEs, and Vivriti, which is a wholesale lender to MSMEs, actually like are the companies that I am closely associated with. Most recently, I made an investment in Sarvagram, which is a rural lender looking at rural households as a means of actually, like as a primary customers for lending. Our next thesis, our budding thesis, is in terms of figuring out what's the next wave that we want to invest in. Is it more of infrastructure play, or is it more on the lending side?
Wow, lot to absorb, lot of insights. So I picked up two key things. Multiple subsectors where you can invest, where you can innovate, where you can find great founders building out great things. Second, take decent amount, big enough stake so that it makes sense to work closely with them. So when I combine these two and I combine 2021, then 22, and now, clearly environment had changed a lot. There was big excess of capital, and now seems like there is almost no capital. Or if there is capital, it's waiting to be deployed, but very conservatively. So from both of you, would love to learn how you are working closely with the founders, the team. What are the key areas where you see scope for improvement, or where you think they need massive support? And if using those things, if there is any learnings or guidance or anything that you want to share with the broader audience, that will be great. And maybe we start with Anuradha ma'am. Yeah?
So whether at Flourish or at TVS Capital, we have been conservative investors consistently. So in that context, for us, this is a more familiar environment than the exuberance of the last 2 years. So we're kind of like heaving a sigh of relief, right? Like, so that's our, and we still have quite a bit of dry powder left. And we're looking at making at least like in the current year about like 4 investments at the minimum. From the current fund, and we are in the process of raising our next fund. Hopefully, like that will start off from the last quarter of this year. In which case, we have the ability to make much more. So we continue to actually, like in real terms, if we look at what has financial services done for people, like especially if you look at the common man, as we call them, the middle class layer solidly. Are all their needs covered? And this is specifically, Hiro, you and I were talking about this, especially if you take the non-urban, the urban part of it out of it. If you go to tier 2, tier 3, if you go to the rural areas, etc., what's your first touch point? Your bank branch is like miles away. You probably have some local touch points where you're doing transactions, but transactions and banking have not necessarily gone together. I don't think most people have gone to bank branches to transact, right? Like that's a thing of the past, right? Like so in that kind of a context, there is the mind maps of people are still not very clear. So that's the space where we think that there will be a lot of opportunities emerging. Currently, most of the opportunities that we have seen, especially in MSME lending, have been more towards actually products, secured lending, products which like LAP, etc., which 5-star is really famous for example. What we think is technology has a role to play, and I don't know how many in this audience are actually like from the lending background, but if I would love to have a debate around, do you think there'll be a technology first self-serve model that goes to these markets? Or do you think that actually like assisted will be there for some time? And what is that some time beyond which it then becomes like, like much more the lending that people like us are used to in urban areas, the digital lending part of it. So that's one thematic that we are still continuing to explore. The last 2 years have also been tough on fintech because of regulations, right? Like, so while there has been exuberance, there have also been the tightening of that end. which we see actually like as a good way, because the industry, when it is not like in a frenzy to go out and do new products and do new loans, will set up the back-end infrastructure much better. So we are still looking for opportunities around the digital lending infrastructure. And that's something which we are pretty keen to. And you know, like, then you are really like ready to run a digital bank, if you will, right? Like when you have your compliance, your back-end, your operations, your management systems, your banking system, your front end all set to work together in a very seamless kind of a way. So far, tech first has been the bastion of fintechs. Will banks catch up? Will NBFCs catch up? Is there going to be a change in the way that the world will function in the next few years? That's actually what we are keen to explore at this point in time. We do believe in balance sheet at TVS Capital. That's one thing that we are actually have a preference for. We're also looking at infrastructure.
So, if you look at from 2019 onwards, I think there are clearly three different phases that we've seen from entrepreneurs' perspective, right? So, there was this 2020, which actually changed, completely changed people's lives when we all got hit by COVID from nowhere. All of a sudden, we had to really deal with that situation where people are not going out of their homes. We were forced into digitization. People who never thought they will ever go online and place orders, they started doing that. So 2020 actually was a defining year in terms of really accelerating the growth towards digitization. It was also the where the governments like US and other governments decided to infuse a lot of liquidity into the system. And so US printed a lot of money to really make sure that people were kind of able to handle the situation. But they didn't realize probably at that time that when you print so much money, you are actually infusing huge amount of liquidity, and that may have impact on inflation and other things. And what happened in 2021, therefore, all that liquidity found its way to India as well, because emerging market doing very well. All of a sudden we saw stock markets going up, the valuations jumping through the roofs. Entrepreneurs, each entrepreneur running with 10 term sheets, with each term sheet better than the other. We saw that was like a year of euphoria for entrepreneurs. Valuations, nobody talked about multiples. It was just about, can you better this valuation versus the other. So I think that was a year of craziness from the VC world perspective. But I think at the same time, there were lots of funds that actually originated at that time who raised a lot of capital in the market. We also saw a lot of, SPACs that got created in the US markets. We're talking about almost close to $300 billion of SPACs that got created with hardly any end goal defined, where the money is going to go at that time. So I think when all this happened, of course, lots of these companies raised so much capital. Then, of course, as inflation started increasing substantially, somebody had to make a correction, otherwise, this can't keep going. So all of a sudden, when that correction started happening, the liquidity started drying up. Therefore, substantial impact on valuations, 2022. All of a sudden, the capital dried up. People started realizing that lots of mistakes were made in terms of giving very high valuations, and therefore entrepreneurs who actually were like riding the entire wave, this up and down. I think people who were not really closer to their business, who were not really driving their businesses with the fundamentals of the business, and they were really not expecting this sudden drying of capital, I think they got severely hit in the process. And if they were burning a lot of money during this process and they didn't think of, the next rounds of capital, etc., and they were only focused on rather fundraising as the next round of capital and not focusing on profitability, I think those businesses were severely hit. And most of the rounds which are happening now, between mid of 2022 and now, and will continue for another 8 months, at least in our view, where the rounds will happen at mostly discounted valuation to the last round that happened in 2022. We are actually doing 4 to 5 deals right now, very good entrepreneurs. Businesses have done substantially better than the last rounds. But we are investing at a 20% discount or 30% discount to the valuation at which they did their rounds at that time. And companies, because the valuation has gone down, companies have completely focused on becoming EBITDA positive. Right? So unless you become EBITDA positive, people are not even looking at you these days. So I think that has become an important criteria. So I think that's the kind of thing which is, important thing to mention.
Sorry, can I ask audience a question or? Okay. All right, anybody who want to ask question, your panelists are here. When they walk out, please do spend some time with them. And thank you for attending the session. Hopefully it was helpful. Thank you very much. Thank you.
Ladies and gentlemen, please, a huge round of applause for our esteemed speakers in the house. All right, ladies and gentlemen, let me once again tell you what is happening in the next workshop, which will start at 3:40. The workshop will be on increasing cash flow and profitability by Zebra at Mahogany. And now we move on to our next panel discussion. The topic for this session is profitability versus growth. Are the rules for investment changing for the better? Investments have come a long way for the fintech industry. This session will talk about how the founders are aligning to new investment environment and the impact on early stage and last stage startups. Now, allow me to invite our speakers for the session. First, may I invite our moderator, Mr. Anuradha, Managing Partner, Artha Venture Fund. Welcome. May I next invite Mr. Mahesh Parasuraman, co-founder and partner, Amicus Capital Partners. And finally, may I invite Ms. Shivani Kulkarni, Senior Associate Investment Prime Venture Partner. Ladies and gentlemen, a huge round of applause for our speakers, please. Over to you, Mr. Anuradha.
All right, thank you so much for inviting us all, and thank you so much to my co-panelists. I think Sanjay put us up to this, so I'm going to ask this question first. With a show of hands to the people in the audience, if you're 100% happy with your bank, could you please put up your hand? If you are 100% happy with your banking partner today, please put up your hand. All right, so that sets the tone for the conversation. All right, nobody put up their hand, by the way. So, let's start off by having a quick introduction, right? Maybe 30 to 60 second introduction. And, you could also just talk about, a little bit about the topic and what do you think about it. So Mahesh, Shivani, you want to go first?
Good afternoon, everyone. I think this is right after lunch, so we'll try and keep it interactive and also try and keep it short. Tough to get everyone's attention at this time. I am Mahesh Parasuraman, one of the co-founders and partners at Amicus Capital. We are an early growth fund that invests across 4 sectors, which is healthcare, consumer, tech, and financial services. Generally invest anywhere from 8 to 20 million in Series B rounds across these 4 sectors. We generally invest in companies once the business model is proven, so capital really is provided for scalability. 2 very important anchors to how we think about our investing, which is capital efficiency, and second is sector leadership. Those are quite important. Generally, about a third of our portfolio goes into financial services. So that's, and we're currently investing out of our fund too.
Hello, everyone. I'm Shivani Kulkarni. I work in the investments team at Prime Venture Partners. So Sanjay, who Anuradha was mentioning, is the partner at our fund, and he typically works a lot with fintechs. So that question. But yeah, we are an early stage fund. We typically do seed, pre-series A, series A, check sizes anywhere less than $3 million is the first check. Fintech is one of the key focus areas, but we also invest in other sectors like SaaS, health tech, EVs as well, very recently. But like Mahesh, third of our portfolio companies are also fintechs, notable ones being Neo, Credex, Night Fintech, one of the stalls that are here. So yeah, I think that's about us, yes.
Great, thank you so much. And you know, the good thing here is that there is a lot of experience investing in fintech on this panel. And you know, FY22, right, was a watershed year. If you look at it in terms of Indian fintech, India is now the third largest fintech ecosystem in the world after the US and the UK. 7,300 startups, 23 unicorns, overall funding of 30.2 billion. Around 8 billion of that came in FY22, so almost 30% of that. But the numbers are also staggering, right? 71 billion payment transactions, 11.8 trillion lent to retail and SMEs, and 55 million active neo-banking accounts. But yet, as you can see, we can safely state that a super majority of the people, the users, are still unhappy, you know, about the state of their fintech services. However, the government sees this as a $1 trillion opportunity. The CEA recently was quoted as saying, you know, we believe that Indian fintech has the potential to be $1 trillion worth by 2030. So I'd love to know from, you know, Shivani, maybe you could go first on this one. So what is the current state of Indian fintech ecosystem, and what needs to get done over the next 7 years to get to that $1 trillion mark?
Sure. Actually, before I start with the current state of fintech, right, let's think about where fintech was maybe 6 years back, like prior to 2016, right? Most of the companies that we can think of that were coming up at that point were just probably an app or a tech layer, and on top of maybe an NBFC or just a tech layer who is an aggregator, right? So there was no real tech getting built at that point. But what changed after 2016 and actually started changing even prior to that was the entire India stack ideation and implementation. So today, I think we are in 2023 now, and I think I can safely say that as a fintech ecosystem, India is the best ecosystem, and if not the best, at least getting there, right? I think it is the best, but some might argue. And what changed? So the change is the implementation of India's stack, right? From the ideation to currently where it is at, be it UPI, be it Aadhaar, be it DigiLocker, and currently with the entire account or aggregator implementation. So what's happening is essentially you're building an entire infrastructure layer for fintechs, for a lot of other people to build on top of. Now, these pipes, these data pipes will help a lot of things that were not getting solved for earlier in terms of maybe say underwriting, just distribution, a lot of other things. Like imagine how you would do KYC earlier, right? I remember when I did my first Zerodha account, maybe in 2015, 2016, I literally had to like submit all papers, courier it to their office, and then I got it within 2 weeks. But today, none of that happens. You can do video KYC, you can do just, you know, e-Aadhaar based, like whatever, OTP based KYC. So that's a big shift. Now, coming to what will be required to make it a 1 trillion economy, right? I think today, after 7, 8 years or 10 years of fintech, the top 10, 20 million of the customers, that's the cream, right, is pretty well served. Like all the people, they have bank accounts, they have multiple bank accounts, they have credit cards, they have insurance policies, they have, at least the fintechs are wanting to serve them. But I think what will be required to move to that 1 trillion is to serve the next set of customers also. Obviously, the top 10, 20 million will always get served the services will become much better. You will have neobanks. You will probably have one integrated platform that is taking care of everything finance, right, for you. But unless you get that next 100 million, 200 million into the foray, serve them to credit, through insurance, through even wealth tech solutions, right? And that, I think, will be what is required to get to that 1 trillion. And that's already happening in a way. Like, there are multiple startups today that are building on top of these data pipes that I was talking about. One example is on co-lending, right? Like, RBI said that, FLDG is something that is not something that they are very comfortable with. So now co-lending will become one of the key things, and banks already want to co-lend. They also want to lend to the priority sector, but today are unable to do it. Now maybe the co-lending regulations, and if somebody is building on top of a stack on top of all of this for co-lending, which will help both the banks and NBFCs maybe lend better with that 80-20 ratio or whatever RBI suggests, I think it will be a win-win for the entire ecosystem. So there are players who are already building on top of it, and I think in the next 5-10 years we'll get there. So yeah, I think serving the next 100-200 million by building on top of data pipes is something that will get us there.
And just as a follow-on, I think, to what you're saying, because as you start getting into the larger mass of customers, see the top cream, usually bigger transactions, right? Yeah. Bigger insurance policies, bigger salaries, bigger. I think what the pipes are doing is probably reducing the cost to go micro, right? And that's where the real trillion-dollar opportunity is going to be. And that's a good segue into, Mahesh, you were talking about, and you split this entire phase into 2 phases. So I'd love for you to talk about phase 1 as you answer this question.
I'm just going to add to what Sakshi said and then come over to your question. Actually, it can become a 1 trillion if you don't do anything stupid, right? So I think that's as simple as that. Simply because we are just retail loans alone is 13% of the GDP today. Financial services sector is 25% of our GDP. And if we grow at 6 to 9% as a country, then the entire sector can grow at between 12 to 15, and and fintechs will take market share off the others. So you're talking of a industry that's growing at 22% CAGR over a 6-7 year period. And as India grows from 2.5 to 5 trillion and more, I think you'll get there very easily, right? But for that, you need to do things sensibly. And what I mean by that is for 2 things to happen. A, business models need to settle in the first place. Second, you need to see what will work in India. That's the other piece that's quite important. You just can't borrow themes from the US and just implement that in India, right? So that's the second piece. And 3, you need to figure out a way to monetize and make money. We are, as a country, the fintech ecosystem in India is quite different to the other markets. It's tightly regulated, which means that you need to figure out a way to make money finally, right? The last one is stop. Entrepreneurs need to innovate, but stop taking racy or edgy calls as far as regulations are concerned. That ain't going to work because you're dealing with a regulator that has the same objectives as you have, but I think will not bend the rules for you to take shortcuts. So I think those are 3 or 4 very important things. Coming to the maturity in the entire ecosystem or the business model settling, in phase 1 was where entrepreneurs came in thinking that they're just going to change the world with technology, but realized that India is a very different market. Credit has its own sets of challenges on the ground. How do you disseminate credit? How do you collect it? You just can't. If Demon is any example, we put back every single rupee back into the banking system, right? So people are much smarter than you think they are. So you need to figure that bit out. Once you give money, it's equally important for you to collect it. It's not somebody else's problem, but your problem. So that's one. Second was the FLDG model in itself, where you are cross-collateralizing the banks who are providing you with capital, paying them a higher rate, and then standing ahead of them and saying, I'm smarter than you. This is an industry that's probably a few centuries old, or as old as any industry can get, and saying, here I am, I'm coming in and I'm going to do things better than you. But that doesn't work that way. So, people are thinking of unlimited leverage and how this model is going to feed into you. I think that's a flawed model in itself. There has to be an equitable sharing of risk and return, which is really what was happening. So as you think about the industry, there was three things that played together. One, business model settled from FLDG, hopefully to co-lending. Regulators saw this coming, I think, and came up with a bunch of regulations, hopefully for the better. And then there is this focus on profitability, because if you're dealing with money, I think it needs to generate capital at some point in time. Concepts that are alien to fintech entrepreneurs need to start becoming very familiar, which is ROA, ROE, and things like that. So, no more staying with CM1, CM2, LTV, CAC, all good terms, but I think finally you need to show that, you're making money. The last bit is leverage, and I think that's the only way you can make money, because as you think of building an ecosystem, money is the lifeblood of business in financial services. And if you're going to circulate this capital out and you're going to get your investors to go out and a fresh set to come in, the metrics start changing. It might start with LTV, CAC and CM1s and whatever, but finally you're going to end up with how much money you're making on every single loan that you put out there. Unless you're a tech company that's supplying, doing all the plumbing, then it's quite different. Then you're a B2B business rather than a B2C business.
I think you bring up a very interesting point, Mahesh, because first, how many fintech entrepreneurs in the room? Quickly, okay, so there is. So, when investors are talking to these fintech entrepreneurs, they're saying, listen, you need to grow, you need to be profitable now, you need to follow the regulations, you need to gain market share, and guess what? You got to increase my valuation at the same time. Now, that's a 5-prong battle. And that's not an easy battle, because India is one of the most regulated fintech industries in the world. We've got 3 elephants that we have to deal with. One is called the RBI, the second one's called SEBI, third one's called IRDAI, or the IRDAI. Then let's not forget the MCA, and then the whole GST, and then I can keep going down the value chain, or up the value chain, as you would like to call it. But while these regulations, and again, I completely agree, and it's been a personal experience of mine that they've been extremely flexible, and they really want this ecosystem to grow, but mostly innovation tends to move faster than regulations, right? And that's a fact. In that scenario, when founders are trying to get all of this aligned, right, usually it's very difficult to get 3 out of the 5 aligned. We're asking them to align all 5. Now, is that fair? Is that possible? And how are you doing that when you're either evaluating a company or talking to a portfolio company?
Go first.
So I think when we talk to our founders, right, one thing that we tell them, and because we come in at early stage as well, right, so that's where they are trying to find the product market fit or just have PMF and are, slightly growing. So we tell them one thing that you need to focus on to begin with is what is that key customer pain point that you're solving for. And I'll tell you the reason why we tell them that and how it ties to your the 5-prong or the 5 prongs which you were talking about, right? So think about this. Now, if you do not have a value proposition that's solving for a very deep customer pain point, you are always going to have to spend money to acquire that customer and reacquire him after 3 months, because all he'll care about or the customer will care about is maybe some discounts, maybe some cashbacks that you're giving him, right? Now, if you find that one gap in the segment or in the market that you can really serve this customer and you can really make this customer happy, then you don't have to really worry too much about spending a lot of money to grow. Now that solves for your growth versus profitability problems, right? Like you're spending low CAC, so I'm going to use that term, but you're spending very little CAC to acquire the customer, and this is a high value customer because he's going to stay with you for longer, right? You don't have to worry about retention because you are solving for something that he really cares about. So that's where at least your profitability and growth is something that you don't have to worry about. All you have to worry about is building that product that serves the customer. Now, then comes, valuations and market share, I think was the other one. So again, like fundraising is just a means to an end for us. Like as investors, we do care about valuation. We do care if our money is doubling or tripling, right? But that will only happen if the company is growing sustainably. The cycles always turn. Like 2021 was a crazy year, right? Like every company was getting funded, whether it's at growth stage, whether it's at early stage. But cycles always turn, and we as investors have to be aware of it and also have to prepare our companies for it. So we always believe that if you can the first thing that you do, right, maintain that growth, profitability, valuation will solve for itself, funding will solve for itself. And with that, even market share, obviously there will be competition, maybe your economics will, not work out for a while. But again, keep going back to that first question. Who is my customer? What is it that I'm doing for him? And incrementally build on top of that. Like most of the successful companies, right, including, Amazon, think about what they did. They solved that first problem, the books problem, very well. They competed with Barnes and Nobles, but in general, their value proposition was any book you want, I'm going to give it to you at doorstep. You don't have to wait for 3-4 weeks or not get it at all. But after that, they built so much on top of it. And Jeff Bezos, the only thing he ever cared about was the customer. He didn't care about, how do I increase valuation for my shareholder. He kept thinking, he kept building those assets, maybe it's logistics, warehousing, whatever it was, to delight this customer. And that's all for valuation, market share, everything on its own. Now here, the different beast is the regulation. Now, I think in India, where it's very difficult to find profit pools, Fintech is a large enough profit pool, because this is one segment, be it lending, be it insurance, be it wealth tech, the customers are willing to pay. Everybody else is struggling, like be it consumers, be it any other segment. Customers in India are typically not willing to pay, but for a lending product, customers will pay even that higher interest rate. So you are in a unique position wherein you can actually make profits and have a good P&L, good balance sheet, good cash flow. That comes with a caveat that because the customers are willing to pay, the regulator is going to be harsh, because the regulator's intent is to protect customers' interest, right? So tough luck. I mean, you need to balance this, and as soon as you understand that the regulator's intent is to serve the customer, to ensure that the benefits are accrued to the customer, and I think the fintechs will know how to build a product. So yeah, I think that's the advice that we give our founders, that you need to know regulation and you need to do everything in accordance to the regulation, but the one thing you need to focus on is the customer pain point and how do I solve it. Just be obsessed with it. So yeah.
Just to add to this, they are not mutually exclusive in my view. Of the 5 factors, I would focus only on 3 of them. The one that I would never focus on is market share. I'll tell you why that is not relevant. You're talking of an industry in trillions of dollars on one side. Unlike in many other technology businesses, in the financial services sector, there is no winner take all. So you don't need to fight for market share and leave money on the table simply because of whatever you're doing. And I think that's a complete myth. So you don't need to chase that piece. I'd be very surprised if you can actually, if anybody can get to a very large percentage. If it does get to, I can tell you that the regulator will jump in there. Okay, so be very, very reassured that you're not going to lose any money or gain any valuation simply because you're going to get market share. Valuation is a byproduct, so I wouldn't focus on that. So that leaves us with the 3 things, right? So that's really growth, profitability, and regulation. Let's face it, we are going to be in a regulated business, and the very important point of view is that if you look at the history of venture and private equity in India, from whenever it started, maybe in the late 90s to today, 90% of all investments in financial services companies, maybe the traditional one historically, has made money for investors. Right? Private equity guys have rarely lost money. And why is that? A, because the sector was well governed, well regulated on one side. Second, they were all profitable with very clear outcomes on where they were headed from a business point of view. If you have a business, if you have an industry that has delivered that kind of stellar returns for investors, which is why you're seeing a lot more investor interest, coming back in. What that really tells you is that the profit pools are massive if you actually execute quite well. So it's all about trying to figure out how well you can execute and monetize So growth and profitability, in my view, are not mutually exclusive. How many industries will you actually find where the underlying industry is growing at, which is maybe a half a trillion to a trillion in size and growing at 15, 18%? Nowhere will you find such large industries, right? So you don't need to go out there and compete with yourself and leave money on the table. I think if you have a good enough value proposition that is compelling and that is reducing friction and solving for a problem, you will, and you can make money. It has been proven in the past. There have been businesses that have emerged from nowhere that today are anywhere from $5 to $10 billion market cap listed businesses in India, in the financial services space, solving for different pain points. And I don't see any reason why fintech can't play the same role, targeting the next 200 million to 500 million. So it is possible.
And so again, it's amazing how what you're saying always alludes to my next question. As investors, we're also a very funny lot, right? Because we keep telling founders the kind of metrics we want to track them on. And if you go back to 1999, when Amazon was created, it was called eyeballs. Then it became clicks, then it became TAM, then registration, then revenue, then margin, then burn. Now EBITDA, tomorrow will be profitability, right? We keep changing the metric with which we're going to value these companies. And therefore, they keep changing the way they keep reporting to us, right? So it's starting to get quite creative, actually. I think sometimes I feel that when I'm going through fintech decks, I think they're almost like D2C decks, right? It's almost like there's a GMV there somewhere, and then you got to figure out exactly what the margins are. And some part is also, I can't blame the founders for it because it does work, right? Obviously, people have gotten funded on such decks. But I would ask you, right? Let's add a fifth regulator or a sixth regulator here, right? That is the VC. Okay, what are the VC-approved regulations for fintech founders to report to us?
I can give you the P regulation, but maybe I'll go after the VC regulation.
Go for it, Mahesh.
So, I think all of you might remember this, Maruti ad, right? So, finally, after all of it, the question is, kitna deti hai? So, I think it finally boils down to that. How much money are you making, right? There's in a leveraged business, if you're going to scale and grow and you're going to use third-party capital, there is no escape from you looking at what is in your hand on a PAT basis, right? Everything else is transitory. So you can get there. There is a time, maybe from, as you move alongside, if you start as an entrepreneur from the other side, moving along in the journey, I think the metrics will change. But finally, as you scale and hit a certain critical mass, there's only one truth, just like our business, which is realized profit. So nothing else matters, right? And it is possible. People have demonstrated it. So I don't see any reason why founders can't follow that mantra to get there. Now, that might change along the way because you can't turn profitable on day one. There's operating leverage. There's all of that kicks in. But that's really it. So think of the Maruti ad every time you look at your business.
Go for it, Shivani.
I'll just, that reminded me of one thing. So I used to have this professor at my MBA school, right? And he used to have this, every class, he used to tell us this, revenue is vanity, revenue GMV is vanity, PAT is sanity, and cash flow is reality. So that used to be...
Could you repeat that? That was a really good one. Let's say that again.
Yeah, so your revenue GMV is vanity, PAT is sanity, and cash flow is reality. So that is what he used to tell us every single class at the beginning of the class. And that actually reminded me of that, right? Because again, I completely agree with what Mahesh said, right? When you start, there are metrics that you will track. It can be, number of customers acquired, what is the CAC at which you're acquiring that customer, and you will build like a basic P&L, which probably will be even CM negative or EBITDA negative. But think about as you evolve, right? He's very right. Like people will want to know ki kya deti hai. what is it that you will eventually be able to get out of this business. You can't always be, you know, like cash flow negative, EBITDA negative. So yeah, I think the fintech founders, and not only fintech founders, I think it's for every startup founder to think about and, you know, reflect on that, how metrics will evolve and how they will be able to get there in terms of profitability, in terms of actual, cash realization. So yeah.
I just want to add to that. I'll tell you why the problem is actually a little compounded for founders looking at it a little, and I'll give you an alternative view. You are trying to solve a pain point in the industry, but coming in from what I would call as a little, with a little bit of a handicap. So it's like playing with a handicap, but trying to solve a very important problem. And what those handicaps are, you're competing with folks who have the advantage of either a lower cost of operation on one side, B, the cost of deposits or their entire borrowing cost is lower. They are in a leverage business where the expectation of a return profile is much lower than you are, versus you where you're raising VC money, private equity money, have a higher cost of operation, don't have the benefit of leverage or a low cost deposit base and trying to compete with each other, right? So what that really means is that A, on one side, your value proposition has to be so strong that it really it compensates for all these limitations on one side and yet continue to make money. So I think that that's one alternative view that you need to keep in mind as you think about it. In a business where scale is quite important, and scale will come with a little bit of leverage because equity capital at some point in time will run out for you, and the only way you can bring and get that debt is when you turn profitable. So it is in a way a self-fulfilling prophecy where you make money, you will be able to raise a little more debt on the side, you'll deploy it, it gives you operating leverage and it keeps growing. So that also keeps founders stake, at a meaningful level. Otherwise, how long are you going to raise equity capital to keep diluting what you're doing, right? Lending out of equity is very good up to a certain point, but you need to get to debt, and there's no escape from that. And the distinction I'm making here is lending businesses on the fintech side, not the technology businesses, which clearly, come from a very different angle. So.
I think, and just before I ask the audience for a question, if there's any questions, if you could put your hands up and, someone could walk around with a mic. But before that, I think, just summarizing our conversation, I think as a ecosystem, India is difficult, right? There's no doubt about that. But I think that in itself is a moat. Because once you start gaining scale, right, and once you crack that model, it becomes difficult for the next person to come in very quickly. So unlike maybe a D2C brand or maybe in other technology plays, you're always asking how far ahead are you of your competition. Usually you're like 3 to 6 months ahead. But in fintech, what I've realized is if you take that lead and you start scaling on that, somebody else getting there is usually not 3 to 6 months. You have a much longer lead and you can probably maintain that unless, like you said, unless you do something really stupid. You can continue maintaining that. So with that, if there's any questions from the audience, I think we can take one, and then I have one final question of my panelists. Cool. So let me ask you a simple question. So I got a video recently, and it's a video of Sam Altman being asked that, Sam, how are you going to make money on ChatGPT? Right? And his response was, well, guess what? I'm going to make ChatGPT so smart that ChatGPT will tell me how to make money on ChatGPT, right? So is that the new fintech paradigm? Are we going to start asking ChatGPT to print out business models on how to make money?
I'd be very worried about that. So, look, it's been done before. I think you have a few names out there that I can put out. Maybe, Stashfin, Moneyview, Early Salary or Five, as they're called. There's, I'm sure there's more. There's Off Business. I'm sure there's more out there. I mean, all of these are Credit B, making serious amount of money every month, right? And I've hit escape velocity in many ways. So it's not that this is escaping all of us. So it can be done. So I think time to maybe for us to go back to the reality and figure out where you can actually focus on getting to profitability over a period of time.
Over to you, Shivani.
No, I think this is a very unique business where the customer sort of pays you upfront, right? Think of lending, think of any other sort of business models in fintech, right? The customer is not saying, okay, I want this for free or the margins are squeezed, like he's saying, right? Like there have been a number of businesses that have already proven this. So business models exist. It's just that you need to, again, answer that first one thing, right? Who's your customer? What is it that you're solving for? And see how those economics work out. I'm pretty sure there are enough and more people to serve here that you can make a very good business out of it. So yeah.
So thank you very much, Shivani and Mahesh. This was a great conversation. I think some of the for me, obviously, was focus on the value prop. And I really liked, Mahesh, you said, listen, do not worry about market share and valuations. They will, you know, if you have too much market share, you're going to invite the regulator as it is. So might as well not get too big. Just get big enough and let the valuations take care of themselves. So with that, thank you so much and really enjoyed this conversation.
Thank you.
Thank you so much.